All right, it's time to start getting a little cautious in the stock market. We're moving into the timing band for the next 4-year cycle low. So here's the last several of these. Of course, 2009, the bottom of the bear market, that was a 4-year cycle low. One could make a case that maybe this is a 4-year cycle low. It's short, but then this cycle here was really long. Sometimes, well, almost always, if you have a long cycle, it will be followed by a short cycle, or a short cycle will be followed by a long cycle. So a weak case could be made that this was a 4-year cycle low. 2016 absolutely was a 4-year cycle low. And of course, 2020 was a 4-year cycle low. And now, when we get into the spring of 24, we're going to be in that 4-year, that timing band for this next 4-year cycle low. I'd mentioned weeks and weeks ago that, actually months ago, that big money, smart money, the banks, the bank trading desks, whatnot, they will almost always manufacture an exit for themselves ahead of a major bear market. And so this decline was never, this was the warning shot that they needed to get to work, that something was wrong, and they needed to get price back up, either to or ideally a marginally break above, to exit out of their long positions and then get on the sidelines or short in preparation for the next 4-year cycle low. And that's exactly what's happened. So if you look at these prior 4-year cycle lows, you'll see this pattern. Here we had this was the warning shot that the housing market was in trouble. They manufacture a rally and a double top to get out of their positions, and then the bear market starts. Something similar here. Pretty similar here. Didn't quite test the all-time highs, but we did get a significant bounce so that they could get out of the way. Same thing happens in 2020, although big new highs, almost a parabolic move, and that was a price was stretched way too far above this 200-week moving average, and that was an indication that this 4-year cycle was probably going to be severe. And it was. It dropped below the 200-week moving average. And basically, any 4-year cycle low in the stock market is going to at least test this 200-week moving average. So we are in the process of allowing big money to get out of their positions, get out of their long positions. They're going to hand the bag off to the retail traders and the hedge funds that are going to be getting too bullish, too late in a multi-year cycle, and then we're going to have a move back down to test or drop. I suspect we're probably going to drop below the 200-week moving average during this next 4-year cycle low. And the fact that we had such a huge stretch above the moving average here in 2022, early 2022, and price did not drop significantly below it. Usually the pendulum will swing a proportionate distance to the other side when you get a stretch that's too far away from the mean. So ideally we would have seen this drop maybe back around to 3,000 and then rally, but it was stopped right here. Remember, this is when the banking crisis was going on and the Fed started printing a bunch of money to save the banking sector. And so that ignited the rally, and it gives the big money a chance to manufacture this rally and exit their stock market positions ahead of the next 4-year cycle. So I suspect we're probably, now we may get a pullback into a daily cycle low once we completely test these 2002 highs, a little pullback, and then what I think would likely happen, this happens very often at these major turning points, is that this big money will manufacture a breakout. So a move above this pivot. And that's what convinces retail traders and hedge funds that it's safe to plow money into the market. We've got a breakout. and we're going to get a sustained move. But this breakout will be coming. Not only is it way too late in this 4-year cycle, but also price is going to be stretched, again, is going to be stretched too far above this 200-week moving average, and that will set the stage for the move down into the 4-year cycle low. And I suspect it's probably going to be triggered by an escalation of the war in the Middle East. That will probably have the opposite effect on commodities, as the CRB is still very early in its 3-year cycle. So I think we're going to get an inflationary impulse and an escalation of the war, and that would be the fundamental driver or the sentiment driver for the stock market to drop down into the 4-year cycle low that it will at least test this 200-week moving average, probably break it. We may even test or go below the October pivot, as we did right here during the COVID crash. We dropped below this pivot. That may happen again. We may drop below this October low. And then the Fed's going to be in a quandary. They're probably going to have a problem with inflation, but they've got a stock market that's collapsing, and they're going to have to make a choice. Do they print and try to save the stock market and stoke inflation even more, or do they let deflation run its course to keep the inflationary forces at bay and let the stock market fend for itself? I suspect they will print and try and pump the stock market back up, which is going to make inflation just go nuts. And that would be the fundamental driver for gold to give us the bubble phase, and that would take a couple of years anyway. If we get our 4-year cycle low here, and I suspect it's going to be in the summer of 2024, then they're going to pump the market back up into the elections. It's going to stoke inflation even more, and the top of the next 3-year cycle in the CRB is not going to be due until probably late 2025. So I think we're gonna be dealing with a severe inflationary phase between now and late 2025, early 2026. So it's time to be cautious in the stock market. I don't fall for the trap of a breakout here, meaning that it's safe to plow money and go back into leverage in stocks. First off, price is stretched too far above this moving average, and it's just way too late in this 4-year cycle to be taking a lot of risk in stocks. You want to really start to tighten your stops up at this point.